Yeah, morning students. I hope my voice is audible to everyone. You will be actually studying with me the most important questions for SEBI relating to accounts and costing, right? So we'll be straight away starting with the questions. If I'm not audible or my voice is low, please let me know. Otherwise, we'll start. So the first important question that we are having right away is that health of an employee can't be recorded in the books of accounts as per which of the following concepts. So there are the options: A, cost concept; option number B says money measurement concept; option number C says historical records; and option number D says matching concept. So any viewpoints on this, you can reply on the chat. Guys, please tell me, what do you think the answer of this question should be? So the answer of this particular question is option number. Yes, are you telling? Good morning, Mayank. Guys, the health of the employee can't be recorded in the books of accounts as per which of the following concepts? Any idea? So the answer for this particular question is money measurement concept. So cost concept says that the fixed assets of the organizations which are acquired should be recorded at the cost. The initial measurement should be at the cost. So some are saying D. Option number D is wrong, guys. Option number B is correct. Money measurement concept is the correct answer to this particular question. Mohan, matching concept is wrong. So Tamanna, Shubham, you are right, and Mayank, you are also not. Now you are right. It is money measurement concept, right? So as per money measurement concept, it says that you cannot record the qualitative items which cannot be quantified in monetary terms. So for example, if I say that there are two organizations, organization A and B, organization A has 6 pieces of land, whereas organization B has, let's say, 1 piece of a land, you cannot say that which organization is better off when it is actually compared with respect to the capital assets. Why? Because if I give you further information that this particular organization B is in the cyber city of Gurgaon, but the organization A is having land in the suburbs of, let's say, suburbs of Delhi. So now with this particular information, you might gather that organization B is having good value of assets, right? So similarly, if and only if certain items in accounts can be converted into monetary items, only then we will be saying that they can be recorded in the books of accounts. So Anjali, your answer is also right. The answer is money measurement concept. Historical records concept says that whenever, we will be recording certain items in the books of accounts, we will be recording as per the historical concept. So whatever transactions has happened during the year, we record those transactions. And matching concept says that the revenues should be matched with the expenses relating to that particular year. So for example, if I purchase a capital asset, that capital asset is giving the benefits to the organization not just for 1 year, but let's say for 10 years. Then the cost of that capital asset should also be spread along those 10 years, because these are actually generating or helping in generating of revenues for the next upcoming 10 years. Therefore, we do not say that the entire cost is the expense of the first year. Rather, we divide this cost among 10 years as per SLM, and we say, or straight line method, and then we say that depreciation will be the expense that should be charged against the associated revenues of those particular 10 years. So I hope that all of these concepts are now clear to you, and the answer to this question was money measurement concept, right? So a lot of you have given the right answer. Now coming on to the second question. The second question says that if the company exercises the buyback out of the free reserves or security, then the funds equal to the nominal value of the shares bought back must be transferred to which among the following reserves? Option number A is revaluation. Option B says retained profits. Option C says a reserve known as capital redemption reserve. Option D says a reserve known as general reserve, and option E says security premium. So which of the option do you think is correct, guys? Out of A, B, C, D and E? So Tamanna is saying C, capital redemption reserve. Okay, others? Shubham is also saying C. Sushil is also giving the answer C. So most of you are right. So good, Tamanna, Shubham and Sushil. You are right in giving this answer. It is capital redemption reserve, as rightly pointed by Sudh Vachan as well. So guys, as the name suggests, capital redemption reserve. Whenever you are redeeming something of the part of the capital, you need to maintain a reserve for it. Why this reserve is required? In order to protect the interest of our creditors or long-term fund finance providers. So if I say that I am having enough of equity, it actually is regarded as a safeguard to protect the debenture holders or fixed liability holders against the losses. If it is not clear, if this point is not clear that why it is prepared, I'll be going into much details. Otherwise, the answer of this question is capital redemption reserve. So guys, if you have any confusion relating to why the amount should be transferred to CRR, then please let me know. I'll explain in detail as well. Right? Apart from that, I'll be explaining that what do you mean by these reserves which are given in the option. Revaluation reserve is the reserve whenever we revalue. Revaluation means upward valuation of the assets. So whenever you are revaluing your non-current assets in an upward fashion, whenever you feel that the carrying value of the asset is way down as compared to the market value or its true value or its true worth, then you yourself cannot revalue your asset. Rather, you will be appointing an independent expert who will be valuing your assets in an upward fashion. And if he gives a revaluation amount which is greater than the carrying value, in that particular case, the amount of profits which are not realized in nature, they will be transferred to a special reserve known as revaluation reserve. Right? So a very good question by Vinom 2021. He's saying that when do we use these reserves? So guys, capital redemption reserve is only having one usage, and the usage of it is that it can be used for distribution of bonus shares. So you can do bonus issue with these CRR. Only usage of CRR is to give bonus shares or to issue bonus shares. Right? The idea behind CRR is that your capital is not deteriorated. So for example, let's say I am your debenture holder, right? And the total equity before I subscribe to the debentures, let's say, was 100, right? And I subscribed to the debentures of, let's say, 50. When I subscribed, I know that there is equity which is in the ratio of 2 as compared to my debt which is in the ratio of 1 in this particular company. So in case the company suffers a loss and the capital deteriorates by 100 rupees, then the the net assets which are lost will be borne by the equity holders and the loss will not be coming to me. But in case the loss actually is greater than 100, in that particular case only the debenture holders will be suffering the loss. So if I take an example, let's assume I'm a bank and the assets that I'm having is the loans that I give to the borrowers, right? Those are my assets. Let's assume I'm having equity of 100 and debt of 50. I subscribe to the debt of 50, and let's assume a simple balance sheet wherein I'm having loans which have been extended by me as a bank of 150, right? What happens is, out of these loans, certain assets become NPA. Certain borrowers are not paying in time, and that is why they are now my non-performing assets. In this case, what happens is, guys, if they are my non-performing assets, let's assume the worth of these assets is only 90 bucks. In this case, the assets are lost by 60 bucks. But who will suffer this loss of 60? If I'm having equity of 100, this loss of 60 will be borne by equity only. The debenture holders in this particular case, if they are redeemed, they will be getting the entire of 50, and the equity will be getting only 40 bucks and they will be suffering a loss of 60, right? They were having a book value of 100. And this is how it happens that whenever there is, debenture holders, there are debenture holders, they do not want the capital to flow away. And that is why whenever you are redeeming a part of your capital, you need to prepare a CRR for it. Right? Coming on to the next question, guys. In which of the following the company receives no cash while getting finance? Option number A is IPO, initial public offer. Option B is FPO, follow-on public offer. Option C is issue of debentures. Option D is issue of bonus shares. And option number E is issue of right shares. So guys, what do you think the answer of this particular question is? So IPO is the public offer that the organization is making for the first time to the general public to get money in the form of equity. Follow-on public offer is the offer that the company is making to the public, but this is not the first offer. So that is why it is a follow-on public offer. Third is issue of debentures. You know, debentures are the fixed instrument which increases the fixed financial liability of the organization. Bonus shares are the shares issued for free. And rights shares are the shares which are given to the existing shareholders in the proportion of their existing shares, but they are having a right price. So the right price is received by the organization in this option number E as well. So Sudh, Vinom, if you are mentioning option number E, that is incorrect. The right answer of this particular question is issue of bonus shares, because in this particular case, the company's profits actually decreases, or reserves and surplus decreases, and the share capital increases. No other effect in the cash actually happens in the case of issue of bonus shares. I hope that this is now correct and it has been understood by all of you. Let's move to the different question now. The next question is, in a rights issue, shareholders are offered shares, and giving of this right to subscribe to the shares is known as which of the following? So whenever the organization is giving the rights issue, which of the following options is addressed as the right issue? That right of rights issue is known as right to profits, right to ownership, right to preemption, residual rights, or preferential right. So which option, guys? A, B, C, D, or E? Let me tell you, right to profits is the right which is there on the profits. Right to ownership means that you are having a right for the ownership. Right of preemption is a technical jargon and it is associated with which of the rights? You must be knowing it. Residual rights are actually the rights which are known as the rights given to the equity shareholders because they are having the residual interest in the profits, and preferential rights are given to the preference shareholders. So Tamanna, Shubham, Sudh, all of you are giving the wrong option here. The answer of this particular question is right of preemption. So this is a technical jargon which is associated with the rights issue. Whenever the existing shareholders are having a right to subscribe to the rights shares which has been given by the company as an offer to them, this is known as right of preemption. Right? Logically, you are correct that they get a right to the ownership. They get the right towards the profits as well. They are having the residual rights as well if they subscribe it. But the rights issue right is known as right of preemption. This is a technical term and it is known as right of preemption. I hope that this is understood by all of you. Let's move on to the different question. The next question is, if the opening stock is 600 rupees and the raw material purchased during the year costed 5,000 rupees and the closing stock is 700 rupees, what will be the amount that will be contributing to the prime cost on an account of direct materials? So guys, what do you mean by prime cost? So Vinom is asking a question that what is the meaning of preemption? Preemption right, preemption means right of preemption is just a technical term which is associated with rights shares. So that right which the existing shareholders are getting to subscribe to the rights shares which has been given by the company to the existing shareholders, that right is known as right of preemption. That is it. Right? So Tekken Games and Tamanna have given the answers. Tekken Games was saying 100 and Tamanna is saying 4900. So guys, let me tell you what do you mean by prime cost. Prime cost is the cost which is very, very prime. And prime means we will be accumulating all the direct cost. So all the direct costs relating to the direct material, direct labor and direct expenses will be clubbed together and they contribute to the total of prime cost. In this question, we are saying that what is the direct material amount that would be contributing to the prime cost. So the answer which is being given by Shivangi, Sushil, Shubham and Tamanna of 4900 is correct. Somehow Vinum and Sud, you are very, very near to the answer, but somehow your answer is not correct. The answer is 4900. Why guys? So we do not say that the purchases is the expenses, right? Out of this purchases, guys, this is very, very important. Listen to me very, very carefully. So let's assume in the current year you purchased 10 shirts costing, let's say, 100 each, right? But you sold only 6 of them. The remaining 4 shirts which are still left with the organization, these have not consumed yet, guys. And if they are not consumed yet, you cannot say that these are your expenses, right? So cost of goods sold only, or the cost of the raw materials which has been consumed, only that cost attributes to the direct material cost. So we say that only the materials which have been consumed, that would be the amount of direct material that has been taken as an expense. So here as well, the opening stock is the stock that you had. You will be consuming it in the current year. Apart from that, you purchased 5000 worth of raw material. But out of this total of opening and purchases of 5600, there is a stock that is not yet consumed in the current year. And you will be consuming this stock only in the next year. So whenever you will be consuming this, for the next year it becomes an opening stock and only then it would be transferred into an expenses if it is consumed, right? So right now, since you have consumed 56 less 700, which is 4900, 4900 would be taken as your raw material consumed, which would be attributing to your prime cost. Vinom, is this clear to you? Sud, Vinom, Kushal, is this clear to you as well, guys? So Vinom, in accounts we say cost of goods which has been sold is the direct material. Vinom, we cannot say that COGS is the prime cost because only direct COGS attributes only to the direct material, which is a part of the prime cost. So direct material is the consumed cost, plus apart from that there is direct labor and direct expenses as well. The accumulation of all of the three will give you the prime cost, right? I hope that this is clear now to everyone. So the answer for this question was 4900. Right. So next question to you guys is, one of the indicators to judge the profitability position of an organization is to compare operating margin, right? Operating margin is the amount of profits which are, earned by the organization from its main operations. How do we calculate operating margin? Option A is GP upon net revenue. Option B is PBT upon net revenue. Option C is PAT upon net revenue. And option D is PBIT upon net revenue. So what do you think is known as operating margin, and how do we actually calculate operating margin is the question. You need to answer me among A, B, C and D. So Shivangi is saying D, whereas Tamanna is saying B. Vinom, Shubham is saying D, and Tekken Games is saying C. Guys, let me actually go through the normal income statement. So answer is D, guys, right? So whenever we prepare an income statement, guys, we start with revenues. We deduct the cost of goods sold and we get gross profit. From this gross profit, we deduct only the operating expenses and we get EBIT, which is earnings before interest or tax, or PBIT, profits before interest and tax. This level of profitability, which has deducted all the operating expenses before it, is known as operating profits, guys. And after this, we deduct interest. Why interest is a non-operating expense, guys? Because for a manufacturing organization, the main operations is not to take loans and lend money as investments. It is the main operations of only a bank. That is why, in case for a general manufacturing organization or trading organization is there, interest is not a operating expense, rather it is an investing expense, and that is why interest is taken as a non-operating expense. And after deducting interest, we get EBT or profit before tax, and we deduct tax to get EAT or profit after tax. So guys, since this is a financing expense, not an operating expense, before this what we have already arrived at operating profit is actually contributing to the operating margin, and we say operating profit upon net revenues into 100 would be your operating margin. So operating profit formula is PBIT upon net sales or net revenue into 100. So option number D is the correct option over here. I hope that this is also understood by each and every one of you. If you have certain queries, I'll be happily addressing those queries of yours. So the answer here is profit before interest and tax divided by net revenue into 100. Let's move on to the next question, guys. The next question says that in case of redemption of debentures, debt equity ratio will, option number A, increase, option B says decrease, option C is saying remains the same, and option D is saying it depends on the amount of debt. So guys, what do you think the right answer of this particular question is? Debt equity ratio, let me tell you, is the amount which actually indicating the capital structure of the organization, that what is the proportion of debt as compared to the proportion of equity in the capital structure of the organization. That means how have you sourced your finance from? Is it from the from that part of the capital structure which actually increases the financial burden more, or it is from that part of the capital structure which actually gives the ownership to others but reduces the risk, financial risk of the organization who has taken the source of finance, right? So some are saying B, most of you are saying B only. Everyone has said B. So Tamanna, Shubham, Shivangi, Vinod and Anurag, you are all right in saying that the answer of this particular question is B. So answer is decrease. Why? Because whenever you redeem your debentures, what happens is your debentures will go down and your cash will also go down. Since the amount of debt goes down, the numerator will go down and therefore the ratio will go down. So the answer of this particular question is decrease. Yes, Anurag, you are right. It is the external liability. Manmeet is also right. The option is decrease. Very good, guys. Next question is, what will be the impact on return on equity if cash is paid to the creditors? Option number A says return on equity will be decreased. Option B says return on equity will be increased. Option C says will be unaffected, and option D says any of the above can happen. So return on equity, how would it affect if cash is paid to our creditors? Any answers to this? Okay, so Shivangi is saying option number A. As per her, return on equity should decrease. Other answers, if any? Okay, let me first tell you that what do you mean by return on equity? Return on equity is the return that the equity shareholders are getting on their investments, which is equity, right? So for equity, guys, what is the return that the equity holders get? Is it PBIT, PAT, PBT? What is the return which is attributable to equity shareholders? For this, you must be knowing that your income statement starts with revenue. If you decrease COGS, you will get GP or gross profit. Decreasing the operating expenses will be EBIT, and after this, from EBIT, you pay to your debenture holders in the form of interest. You will be left with EBT. From this EBT, you pay taxes, which belongs to the government. So when we pay taxes, we are left with EAT or PAT, and from the PAT, we pay dividends to the equity holders if there is no preference holders. Otherwise, we'll be first of all giving preference preference dividends, only then the profits after preference dividends will be the profits which are attributable to equity holders. So guys, if you see here, the profits that belong to equity holders is not EBIT. Rather, these are for the debenture holders. They are not EBT because this is for the government as well. But the profit that belongs to pure equity holders is EAT or PAT. So PAT or profit after tax upon the equity shareholders funds would be the formula for calculation of return on equity. Whenever you are paying cash to your creditors, what happens is your liability in the form of creditors will go down and your cash also goes down. Nothing will affect your PAT and nothing will affect your equity shareholders if none of the numerator as well as the denominator, none among them is getting affected, the ratio of return on equity will be unaffected. So the right answer is unaffected, option number C. So rightly pointed out by Tamanna, Kushal, Vinom, Goswami. I think that now it is understood by everyone and the right option is return on equity will be unaffected, right? Let's move on to the different question now. Question number 9 says discount rate used for calculation of net present value is A. Opportunity cost of capital. Option number B. Opportunity cost of the industry. Option number C. Cost of capital of the competitor firms. And option number D says rate of return on 10-year treasury bonds. Which of the options do you think is the correct option for this question, guys? Yes, I'm waiting for your reply. Please let me know that which among the following is correct option as per you. So the right answer over here is given by Vinom. Very good, Vinom. In a very short span of time, in a span of just few seconds, you have answered it correctly. Along with that, Kushal, Sarath, Anshu, Shubham, all of you are giving the right answer. Somehow, Tamanna, you are wrong in this particular question, even though your knowledge is really good. And Anurag, you are also right in this question. So guys, the right answer for this particular question is opportunity cost of capital. Goswami, this time you are incorrect. It is not rate of return on 10-year treasury bills. Swati, this is also incorrect. Option number D is incorrect. Okay. So guys, the right answer of this particular question is opportunity cost of capital, because this is the cost of your capital, and for calculation of the NPV of your projects you must use the opportunity cost of your capital, right? Second games we will be coming to that particular question as well. So you will be having accounts and commerce, which I'll be handling, right? So we will be doing questions on this right now, and we'll be discussing the relating things like the ones that you are saying in a span of time. So cost of capital of the industry is the total industry's cost of capital. We will not be including that in our projects NPV. Competitors firms again is irrelevant for calculation of our NPV, and rate of return also is on 10-year treasury bond is also not relevant for our cost of capital, right? So answer is opportunity cost of capital. Question number 10 says once adopted a policy, it should not change it frequently because this can help the organization to modify profits wrongly. This is true as per which of the following accounting conventions? Option number A is full disclosure, B is materiality, C is conservatism, and D is consistency. Very good. This question you are rightly pointing out, Shivangi and Vinom. The answer of this particular question is consistency. Right, Anurag, you can take the fifth option as going concern. Right, I'll be giving you the fifth option as well. Don't worry, Anurag. So here the right option is consistency. Very right. Everyone has pointed out rightly. It shows that you are preparing well. So once a policy has been adopted, it should not change frequently, because the investors might be getting the modified information which may not be right. Right. So that is why consistency is very, very important, and it is one of the accounting conventions as well. So all of you have rightly pointed out that the answer is consistency. Coming to the next question, guys, income tax is to be paid on which of the following profits to the income tax department? Is it profit before tax? Is it taxable profits? Is it revenue from operations? Is it GP, or is it operating profit? So Anurag, in this question we are having 5 options. So tell me, which do you think is the correct one? Which among the following is the correct option as per you? Profit before tax is the accounting profit before tax. Taxable profits are the profits which are adjusted as per the Taxation Act prevalent in the country. Revenue from operations is your sales from your operations. GP is the amount of net sales minus cost of goods sold, and operating profits is EBIT. So all of you are writing PBT, which is somehow a wrong answer. Guys, so whenever income tax is calculated, in your income statement, we say that revenue minus cost of goods sold give you GP, from which you deduct operating expenses to get operating profits, which is EBIT. From it, you pay interest and you get EBT, and you then deduct tax. So from PBT, you deduct tax to get PAT. But the tax which is to be paid, this is the accounting tax, guys. But there is a difference. There can be a difference between accounting tax and the tax that you pay to the income tax department. And income tax department collects tax on the profits which are not your book profits. Rather, what are your taxable profits? Taxable profits are calculated as per the rules and regulations which are drawn in the Income Tax Act prevalent in our country. So we are having Income Tax Act 1961. There are certain amendments which actually happens. So we will be paying tax on the taxable profits, guys, and not on the profit before tax. Right? So taxable profits are calculated as per Income Tax Act, and as per them, we pay taxes to the Income Tax Department. Option number B is the correct option. Right. Yes, Anshu, it is taxable profits. Right? I hope that everyone has got the right answer here. Next question is, which among the following is a revenue reserve out of the 5 options which are given below? So A is CRR, B is security premium, C is DRR, which is debenture redemption reserve, D is revaluation reserve, and E is general reserve. Guys, which of the following do you think is the right option? So CRR, we have already talked a lot on CRR. It is the redemption. Whenever you are redeeming your capital, that is the reserve that you create. Securities premium is the reserve that you get whenever you issue your share securities at a price greater than the par value. Debenture redemption reserve is the reserve which is created for redeeming your debentures in a timely fashion. Revaluation reserve is a reserve on your non-current assets, and E is the right answer. It is general reserve. Very right. All of you are pointing out rightly. General reserve is the revenue reserve, guys, and general reserve is actually made out of your retained profits. You must be knowing that as well. Priyanka, PDF for what, dear? You need PDF for the questions here. If you require PDF for the questions, I'll ask Suvarna ma'am to arrange for you. Next is, dash is the time between the acquisition of assets for processing and their realization in cash or cash equivalents. So option number A is financing cycle, B is investing cycle, C is operating cycle, D is accounting cycle, and E is capital maintenance cycle. So Priyanka, you can mail us to hello@ixamBee, which is the email ID given on our website, and you'll be getting the PDF. right? You can ask for the PDF in that particular site, in that particular mail. You will be getting the PDF. So Tamanna is saying operating cycle, option number C, whereas Agnik is mentioning option number B. Vinom, you are also mentioning option number B. So dear, option number B is incorrect, Vinom. And Angit, Agnik as well, you are wrong. Dear, rest of you are right. So Tamanna is right, Shanky Cool is right, Anurag is right, Swati is right. Shanky Cool, now you are incorrect in saying investing. Goswami, you are correct. And Anshu, you are also correct. So the right option is operating cycle. Guys, operating cycle is the cycle which is known as the amount of time which is actually involved for your cash to again get converted back into the cash. So guys, you are having cash. That cash is actually converted into raw material that you purchase to sell, right? Those raw materials are kept in your organization and gets converted into WIP. Then they get converted into finished goods. The entire period of conversion of raw materials into finished goods is known as stock holding period or inventory holding period. Then after finished goods, you sell the goods on credit and you get account receivable. The amount of days the receivables actually takes, these are debtor collection period, known as debtor collection period, right? In between, you can get payments payable period as well, payables payment period as well, because this is the amount of credit for the number of days that you get from your creditors or your suppliers, right? And then your debtors, which have taken after the debtor collection period is over, then they pay you cash. So the entire this time is actually blocked. Your cash is blocked for this entire time. So we are actually, the question is asking you that what is the time between the acquisition of assets for processing and their realization in cash to cash equivalents. So this cycle is known as, guys, operating cycle. So Anshu, that is a wrong term that has been given just to confuse you guys, right? No, Vinom, it is stock holding period. Raw materials to finished goods is your stock holding period, okay? Or inventory holding period. So the answer here is operating cycle. Next is for a manufacturing concern. Anurag, I did not understand your question, that post operation period. Please give the full question that you want to ask. The next question is, for a manufacturing concern, what will be the effect of increase in debtors on the cash flow statement? Is it negative effect under operating, or is it negative effect under financing, or is it positive effect under operating, or is it a positive effect under financing? So option A, B, C, D, and option number E is no effect on cash position. Okay, so Agnik is saying option number A. Others, Shivangi, Khushal, all are saying option number A. Guys, very right. You are rightly pointing out the answer is A, not C. Vinom, your debtors are not your finance providers, right? Debtors are the persons to whom you sell goods on credit, and selling goods is your main operations. So they come under operating activities under working capital, changes in working capital, right? So this is the answer of this particular question is negative effect on cash flow under operating cycle with increase in debtors. Let me tell you why it is creating a negative effect. So guys, whenever your debtors are increased, actually what happens is, let's assume earlier you had 50 of debtors and now you are having 100 of debtors. That means earlier your 50 bucks was blocked in debtors, but now you are not getting 100 rupees of cash as of now because you have blocked 100 rupees in your debtors. And whenever the debtor collection period is over, only then after that period you will be getting your cash which will be realized from your debtors. So the amount of time for which the cash has been blocked increases, and that is why on the cash it creates a negative effect. Right? No problem, Vinom. I think now the answer of this particular question is clear to Anurag and Sudh as well. Rest of you were right. Urban, I hope that now the answer of this question is clear to you as well. If not, please let me know. The answer is negative effect on cash flow, cash position under operating activities. Next question is question number 15, which says interest received on bonds will come in which of the following activities in the cash flow statement? Is it A, operating? Is it B, investing? Is it C, financing? Is it D, which can be B and C? And E says A and C, which is operating and financing. Rightly pointed out by you, Rahul, you are having the potential to receive them in the future. But what happens right now is that you prepare a cash flow, right, depending on the uh, items which are prevailing as of now. So for those items, if you prepare cash flow as per indirect method, it is creating a negative effect because your cash is blocked, right? A lot of you are giving answers. So some of you are saying B. Majorly B is the answer that is being given by all of you. Shivangi, Tamanna, Vinom are saying B. Sud, Navneet, Nayan are saying D and C. Shubham is saying B. Some are saying B and C as well. Okay. So guys, Surbhi, Anshu, Rahul and Urban Bollywood, you are right in saying that the answer is B over here. Guys, the answer is B. Why? Because whenever you are receiving interest, you receive interest or dividends only on your investments. You give interest and dividends when you finance, right? So whenever you issue the debentures, you have to give interest, you have to pay interest. Whenever you issue equity, you have to give dividends. Whenever you invest in equity of another company, then you receive dividends. And whenever you invest into bonds of other companies or government bonds, then you receive interest on them. So only on your investments you receive. That is why it comes under investing. I hope that it is clear to everyone now. If not, please let me know. I'll be explaining you again. So the answer here is investing. Next question. Let's study the next question. Which among the following is not an example of a normal loss? Guys, this is from process costing. Option number A is carelessness of employees. Option number B is evaporation loss. Option C is unavoidable spoiled quantity. Option D is loss due to normal conditions. And option E is nature of the operations. So guys, which among the following is not an example of normal loss? This is the question. So Naga Adi, that will be taken up in the next class, maybe in one of the next classes, okay? This class is for SEBI accounts and costing questions, so we are addressing them. Very right. Most of you are giving the right answer. It is carelessness of employees. Anshu, the question is not an example of normal loss, dear. And you're saying normal conditions? No, loss due to normal conditions actually will be an example of a normal loss, isn't it? Evaporation loss is also taken as a normal loss because we cannot actually help it if evaporation is actually happening. Unavoidable losses are always normal losses. And nature of operation here, then also it will be a normal loss. So guys, the answer of this particular question is carelessness of employees. If you are if you're showing carelessness, only then the actual loss of yours will be greater than the normal loss, and the difference of the actual loss and the normal loss in this particular case would be an abnormal loss, right? So the reasons for abnormal loss could be carelessness of your employees, and if you are doing more wastages as compared to what it should be or what it should happen on a normal course of action. So the answer is carelessness of employees. Coming on to the next question, as for which concept total notional profits should not be transferred to P&L account, but the portion of it should be kept in reserve to meet any unforeseen future expenses or contingencies. Guys, this particular question is taken from contract costing. So the options that are available to you is A, matching, B, prudence, C, going concern, D, business entity, and E, dual aspect. It says that so whenever you are having your contract in which the work is not completed yet, right? That is why we say the notional profits. Work is not completed yet, so but you are having a proportion of the work that has been done. There are notional profits. All those notional profits are not transferred to your P&L account right away. Some part of it is transferred to your P&L account, whereas some part is kept as reserve only. Why? Because there may be future contingencies. So most of you are giving the right answer. The right answer is prudence. As the name suggests, prudence or conservatism says that please anticipate for future losses as well, right? So the definition of prudence and conservatism actually will answer the question number 17. It is option number B, prudence. So most of you are right in saying that it is prudence, right? Good. Good, you are answering correctly. Most of you are correct in this answer. Okay, the next question is how to compute estimated profit under a contract account. Estimated profit is the profit on your contract, which is given the name when the contract is completed, the work is completed in the contract, which is greater than 90% of the work which is promised. Option number A is value of work certified plus work uncertified less cost of work to date. Option number B is this. Option number C is this. Option D is this. And option number E is this. So question is how to compute the estimated profit under a contract account. You must know the difference between notional profit and estimated profit when it comes to contract costing. Notional profit is the profit when the work is not completed and the work is lesser than 90%. And when you are reaching to the stage of completion, it is known as estimated profits. So for estimated profits, there is one correct option, which is not A, not B, not C, not D, but option number E. So Surbhi and Tamanna, Shivangi and Saurabh, no, not Saurabh, Surbhi, Shivangi, Tamanna, Shubham, Vinom, and Agnik, Navneet, BS Prasad and Navneet, you are actually giving the right answer. The right answer of this particular question is option number E. As I told you that estimated profits are the profits that are there when the contract actually is near completion. So we say that now it is certain that you will be completing the contract, and contract price is the revenue that you will be getting on completion of the contract. So it is contract price minus the cost that has already been incurred till date. And since contract price is for the entire contract, therefore the cost should also be taken for the entire contract. The cost till date and the additional estimated costs. Right? So option number E is the right answer. Contract price minus total cost already incurred minus estimated additional cost to complete the contract. Right? Very nice. Option number E is the right answer. Guys, coming on to the next question. Next question says plant introduced at the start of contract. Again, it is belonging to the contract costing. There's a plant which you have introduced in your contract with the cost of which is 90,000. The depreciation amount is 10,000. For the current year, so you have used the plant to the tune of 10,000. Right? In the plant, what happens to the treatment of a plant on the current year's contract account? Should the contract account be debited by entire 90,000? Or should it be credited by entire 90,000? Or should it be debited by 90 and credited by 10? Or should it be credited by 90 and debited by 10? And the last option is contract account will be debited by 90 and credited by 80. So most of you are saying option number D. Some others are saying, I think, E as well. Navneet, Anshu, all are saying D. One is saying C. Tamanna, you are saying C. Guys, you know what happens whenever you prepare a contract account, there are two sides of a contract account normally, like a ledger account. So there is a debit side and there is credit side. On the debit side, we say that we will be transferring all the cost, and on the credit side, when the contract is completed, we credit it with contract price. Otherwise, we credit it by the WIP, which can be value of work certified and value of work uncertified. Right. Here, guys, you have used not the plant which is of 90,000. You have just used 10,000 from the plant, isn't it? That means the net cost or the net debit should only be 10,000. The one option is that you can debit only the amount of depreciation of 10, or the second option is that you can debit the total cost of 90, but you have to credit the closing stock of plant of 80, so that a net debit of 10 only actually is happening in the contract account. So with this information, guys, now tell me that what should be the right answer. Should it be A, B, C, D or E? In which of the options are you getting a net debit of only 10? That would be the correct option. In option number A, the net debit is 90. Option number B is totally incorrect if says that net credit should be 90. Option C says net debit of 80, which is also incorrect. Option D says net credit of 80, which is also incorrect. Whereas option E is correct because here the net debit is of 10. Right? So guys, for this question, option number E is the right answer. Coming on to the next question. So answer is this, option number E. The next question is, guys, materials introduced for a particular contract amounted to 60,000, out of which material worth 4,000. So if you have actually learned the concept of the previous question, you will be giving the right answer over here. Tell me what should be the right answer over here. If you have introduced 60,000 to a particular contract, out of which you have transferred 4,000 to another contract, and when the contract gets completed, there is a closing stock of material of 4,000 which is unutilized or unused at the end as well, right? So what should be the treatment of material on the contract account? Guys, tell me which of the options now do you think that should be correct in relation to contract account material cost? So Shivangi, when the whole asset is used, for example, you introduced an asset, the cost of which is 90,000. If the entire asset has been consumed, the entire contract account would be debited by entire cost of 90, because the opening value with which you introduced the asset was 90 and the closing value is 0. That is why you are saying that the entire asset has been used, right? So in that case, the entire 90 would be debited. But in the next case, if the part of the asset is consumed, then only the depreciation amount, right, which is the difference between the opening and the closing value of the asset for that year, would be debited in your contract account. So these are the two different situations. Shivangi, I hope that now you have got the answer. So now also most of you are saying C. Tamanna has taken back her option because she has felt that she was wrong, I think. So let me also take a look at the options. Option number A is material worth 56,000 is to be debited. Okay. Option number B says credited, which is very wrong. Option number C is 60,000 is to be debited and 8,000 is to be credited. Okay. Option D says the opposite, which should not happen. And option E is also the incorrect option. So option number C is the right answer. Namrata, you can please mail it to our email ID, and I think Suvarna ma'am will be giving you the PDF. Okay, very in a very short duration of time. Okay, we will be taken into consideration and I'll be saving this PDF for future use of yours. So guys, in this question, option number C is the correct option because the contract account has used only the material of 52,000. So whenever a net cost of 52,000 is debited, that is the correct option here as well. You have introduced 60, so you'll be debiting 60, but 4,000 and 4,000 since you are not used in the current contract account, you will be crediting it by 4,000. And also the closing stock which is not utilized in this year is also 4,000, you will be crediting it again. So therefore the net debit is 52. So option number C is the correct option here, right? So with this, we are at the end of our session. We have completed 20 important questions relating to SEBI costing and accounts section. Guys, if your progress is, clear and you can see the progress, you can answer the questions, I think that you should not worry much. But if you are finding difficulties in answering these questions, then please brush on your concepts, because this is the important and ideal time where you should brush on, but where you should be brushing on your concepts, right? So with this note, we will be ending the session. Thank you guys, all of you. If you have any questions, you can write it in the comment section. We will be trying to help you out, right? So bye bye guys. Please attend the live classes. These will be very, very helpful to you, and we will be having a lot of live classes for the benefit of you only. So please try to make an attempt to actually attend the class and take the benefit out of it to the most, right? Thank you guys. Thank you.